again, is also another example of why the Fed's inflation fight will not work, because we're not going to combat inflation unless we get a pickup in the savings rate. People have to save money and not spend it, but they're not doing that. In fact, one of the reasons they're not doing that is because of inflation. Inflation is so eviscerating the value of their paychecks that they have no choice but to tap into their shallow savings pool to try to make ends meet. But since the Fed still has negative real interest rates, even though interest rates rose to 2.25% to 2.5%, with inflation at 9%, you've got negative 6% real interest rates. What idiot is going to save money if they're losing 6% a year? So because the Federal Reserve is still punishing people for saving, they are not saving, they are spending. And because consumers continue to spend and not save, you will still get more upward pressure on prices. Now, we also got the final read on consumer sentiment in June. It was supposed to come out at 51.1, which is a very, very low number, indicating a high degree of pessimism. And the number did come out slightly above estimates at 51.5, but that is still a very low number and in no way is indicative of a strong labor market. In fact, it indicates a weak labor market. Why are workers so pessimistic? Because they're working for lower real wages. Look, even if we had inflation, if wages were rising faster than prices, workers wouldn't be complaining. As long as your real income is going up, it doesn't matter that prices are going up if your wages are going up faster. The problem that workers have is that prices are going up faster than wages, and that's because we have a weak, not a strong labor market. And again, the reason that consumers are so pessimistic is because they are living in a recession. They are not living in some democratic fantasy where the economy is still booming. They are living in the reality of an economic bust. And we got more evidence that that bust is continuing in the third quarter with the release on Friday of the Chicago PMI. It was supposed to come out at 56, which would have matched the 56 read from the prior month. The range of expectations went from a low of 55 to a high of 56.5. The actual number came out all the way down at 52.1. That's about a 2-year low in the Chicago PMI. You have to go back to the depths of the COVID shutdown to find a number this low. And in fact, I think before long, that number is going to break the 50 level and have a 40-something handle on it, which will clearly confirm that the economy is in recession and that recession has continued into the third quarter. Now, I want to switch gears a bit and talk about some of the legislation that has made it through Congress and will be on President Biden's desk for signature. One piece of legislation is this $79 billion CHIPS Act. Now, first of all, this particular act is completely unconstitutional. There is nothing in the U.S. Constitution that authorizes the U.S. government to pick winners and losers and to decide to invest taxpayer money in particular businesses and hand over that money to industries like the computer chip industry. It doesn't matter if Congress wants to decide that computer chips are a vital industry and wants to invest U.S. taxpayer money in companies that are making those chips. Although I don't see how it's an investment because there's no return to the taxpayer. It's just simply a grant. The U.S. government is giving $50 billion to private companies. It has no constitutional authority to do that. Capital needs to be allocated in the private sector, not the public sector. If computer chips are viable, which of course they are, and if they're necessary, then there will be a profit associated with producing those chips. And because private investors are incentivized by profits to make investments, there will be private sector investment in this industry if that is in fact what the country needs. And so the government needs to stay out of it. This is not an example of capitalism. This is an example of socialism.